Assalamualaikum and hi everyone. This video I was created because I want to expose about accountability and corporate governance regarding to financial crisis of 2007 until 2009, which is financial institution collapse. First at all, I want to explain for meaning of corporate governance. Actually, corporate governance consists of a set of internal procedure, law, and informal guidelines that govern how corporate officials make decisions and who bear responsibility for the loss or injury that follow such decisions. The objective of the system is to ensure that corporate decisions are made with the best interests of the whole of corporation. The financial crisis of 2007 until 2009 was a crisis truly global in nature that affected all regions and countries of the world. For the issue above, I want to expose the role of corporate governance in the financial crisis using this system to center of the crisis. According to this topic, many financial institutions collapsed, and then many researchers, scholars implicate corporate governance as one of the main reasons for global crisis. Many banking and financial institutions did not pay due attention to corporate governance before and during the crisis. As an evidence of corporate governance deficiencies, I choose Lehman Brothers as a reference to relate it with the issue above. Here, I want to touch on Lehman Brothers case more detail. These matters incurred because of Lehman Brothers had a weak corporate governance arrangement which is failed to safeguard against excessive risk, taking up partly to blame for the economic crisis. The key areas of weaknesses that have been highlighted in Lehman Brothers are: first, corporate risk management; second, remuneration scheme; third, board of directors; and lastly but not least is transparency. First issue I want to explain is corporate risk management. Lehman Brothers has many communities. One of them was a finance and risk community. The chief finance officer and chief risk officer should meet weekly to discuss all risk exposure, position consideration, and risk-taking activities, but they only meet twice in both 2006 and 2007. But during the crisis, Lehman developed significant exposure to risky subprime lending, commercial real estate, structured product, and high-risk lending for leveraged buyout. According to Valucas report, indicate that Lehman rapidly breached its own risk consideration limit to pursuit of higher earnings. Besides that, failing by Lehman Brothers executive and their auditor led to bank collapse and bring to the financial crisis. So the role of corporate governance is very important here to prevent and overcome of corporate risk. Lehman Brothers need to adopt corporate governance to overcome their problem. To support their statement, according to Tariff 2010, argue another area of improvement and reform identified in the aftermath of the financial crisis was risk management. Besides that, to conclude, the key lesson for bank for this crisis was to have a separate broad risk management control under the authority of the chief risk officer. A second area of concern in the global crisis was remuneration system in Lehman Brothers. Based on Lehman Brothers case, remuneration system to the top executive of Lehman Brothers so high received A study from researchers at Harvard University showed that the top executive manager of Lehman Brothers received about $1 billion respectively from cash bonuses and equity sales between 2000 and 2008. Besides that, board of directors at Lehman Brothers was paid well for their service in fees that range from $3,000 to $400. Here, we can see that the structure of director remuneration system at the Lehman Brothers more favorable to them compared to their staff, which is receive a disproportionately high percentage of the pay in Lehman stock and option. So the role of corporate governance is important here. To improve of remuneration system, Lehman Brothers need to adopt corporate governance framework to overcome the problem. According to European Commission 2009 lesson for improving the remuneration system, they focus 4 areas of improvement. First, structure of director remuneration. Second, severance pay. Third, balance between fixed and variable pay. And last, linking compensation with performance. A third area of concern in the global crisis was board composition and practice. Many researchers called upon changes in the board composition and directors' competence based on the learning gathered from the crisis. According to Milbert 2009, suggests board to have individuals with the financial knowledge or some related expertise to deal with a risk control and management of the firm. Besides that, according to Adam 2009, also suggests director of financial firm need to have sufficient financial knowledge and expertise. This may be done giving directors sufficient training and education support or hiring new directors that possess this quality. But directors of Lehman Brothers had a diversity of professional experience. Unfortunately, they don't have a significant lack of experience on financial issues. This issue here is no one directors can make a decision during financial crisis, so they had to go through the crisis without making any reasonable decision. Besides that, 4 of the 10 member boards at the Lehman Brothers were over 75 years of age. This factor made the Lehman Brothers collapse because of no financial expertise that can prevent the risk of financial crisis. So the role of corporate governance to Lehman Brothers is defining the role and qualification of non-executive director so that they can better question the management. Besides that, to reduce risk-taking behavior, directors must be adequately paid to meet the difficulties and bear the responsibility of their position. Last issue is accounting standard and transparency. The companies must analyze the risk disclosure based on cost-benefit analysis and its extent in affecting the company's existence. Based on Lehman Brothers case, one of main failure was the misbehavior of top executive and the inaction of both the board and auditing firm Ernst & Young. Actually, there are many similarities between the collapse of Enron in 2001 that they managed to reduce leverage on the right hand side of the balance sheet. At the same time, reduce assets on the left hand side. In Lehman Brothers, repo 105 transaction doubled between late 2006 and May 2008 were known inside the corporation. Accidents in firms have imposed limit and typically happen at the end of each quarter, when financial information had to be released. Besides that, Lehman Brothers was unable to retain the confidence of its lenders and clients. This is because it did not have sufficient liquidity to meet its current obligation. So, if Lehman Brothers adapt corporate governance framework during the financial crisis, they can address the issue of volatility by using fair value accounting and transparency of on-off balance sheet item. But they are not make it to support the statement. Club 2010 suggests a universal accounting and valuation method to ensure fair reporting to shareholder and investor. Besides that, in deriving a lesson from the crisis, suggested the need for a new risk disclosure policy and some guideline on risk management accounting. The conclusion about the whole issue: the recent financial crisis was really a global crisis in terms of a reach and scale of impact. It affected almost all the economies of the world, and losses incurred by shareholders and investors were great. Corporate governance failure was one of main reasons for this crisis. This statement shows several aspects of corporate governance that failed during the global crisis in financial institutions, especially for Lehman Brothers. First, risk management system, transparency and disclosure, board oversight practice, and remuneration system. This statement is significant from the perspective of regulators and policymakers. Lessons from the failure of corporate governance in banking and financial institutions may be generalized for the development of new policy guidelines, not only for the financial sector, but for all non-financial companies. The implication and lesson drawn from this crisis can trigger a new area of corporate governance reform, and new best practice may evolve that may be applied to different jurisdictions. It is an appropriate time for regulators of corporate governance to keep abreast with contemporary scenarios and raise the standard of corporate governance in order to protect the wealth of millions of shareholders. That's all. Thank you very much.